Most people believe Africa is still economically controlled by Europe or the United States. But what if I told you that the real power shift already happened quietly, without wars, without headlines, and without most people even noticing? Today, China is Africa's largest trading partner, moving over $300 billion through African economies every single year. No invasion, no colonies, no flags raised, just trade, infrastructure, and long-term strategy. And once you understand how this happened, you'll realize this story isn't really about Africa at all. It's about how global power actually changes in the modern world, and who is shaping the future while everyone else is distracted. This didn't happen overnight. There was no single deal, no dramatic announcement, no breaking news alert that warned the world. Instead, it happened slowly, step by step, road by road, port by port. And that's exactly why so many people missed it. Because the most powerful changes in history often look boring while they are happening. You're watching Finance Historian Time, where we break down real financial history, real power shifts, and the systems that quietly shape your future. To understand how China quietly took over Africa's trade, we first need to understand the position Africa was already in. By the time most African nations gained independence in the 1960s and 1970s, their economies were fragile. Colonial powers had built systems designed to extract value, not to create it. Railways ran from mines to ports, not between cities. Roads connected resources to ships, not people to opportunity. Even after independence, that structure largely remained. When African governments turned to Europe and the United States for development, they were offered loans, aid programs, and advice. But those offers came with conditions: cut spending, privatize assets, open markets fast. In theory, these policies were meant to help. In reality, many countries ended up with rising debt, weak infrastructure, and economies still dependent on exporting raw materials. This is where China enters the story. In the late 1970s and 1980s, China itself was still a poor country. It had experienced isolation, underdevelopment, and internal chaos. Chinese leaders understood something the West often forgot. Without infrastructure, trade cannot grow. And without trade, economies stay poor. So when China looked at Africa in the 1990s, it didn't see a charity case, it saw potential. Instead of arriving with lectures, China arrived with engineers. Instead of promising reforms, it promised construction, roads, power plants, railways, ports. These weren't gifts, they were part of trade relationships. If China wanted oil, it helped build pipelines. If it wanted copper, it invested in power generation and transport. Trade and infrastructure were tied together, creating a system where both sides depended on each other. At first, this relationship was small enough that few people cared. In the year 2000, China-Africa trade was only about $10 billion. Europe and the United States were still dominant, and Africa was no longer a priority for many Western policymakers. But China was patient. While Western companies focused on short-term profits and low-risk environments, Chinese firms were willing to enter difficult regions and wait years for returns. This wasn't charity, it was long-term strategy. By the mid-2000s, Chinese construction companies were everywhere across Africa. Highways in Kenya, railways in Ethiopia, ports in Nigeria and Djibouti, industrial zones near coastlines. Slowly, Africa's trade arteries were being rebuilt, and China was deeply embedded in all of them. As infrastructure improved, trade exploded. Africa exported oil, minerals, and raw materials to China. China exported machinery, electronics, vehicles, and manufactured goods to Africa. Supply chains formed, contracts multiplied. By 2009, China officially became Africa's largest trading partner, surpassing the United States. This moment barely made headlines, but it should have. Because when trade shifts, power shifts with it. Being the largest trading partner doesn't just mean selling more goods. It means influencing prices, shaping supply chains, and becoming essential to economic survival. Over time, it also creates political leverage, whether anyone admits it or not. African governments didn't choose China because they were forced to. They chose China because China delivered things that others talked about but rarely built. Electricity that worked, roads that connected cities, ports that could actually handle global trade. By the time the world started warning about China's influence in Africa, the system was already in place. The contracts were signed, the infrastructure was built, the trade routes were locked in. But here's the uncomfortable truth. This $300 billion power shift isn't just changing Africa. It's reshaping global trade, weakening old economic empires, and quietly rewriting who sets the rules of the world economy. By the time China became Africa's largest trading partner, a new narrative started spreading in Western media. Words like debt trap, neocolonialism, and Chinese takeover began appearing everywhere. But real history is never that simple. To understand what is actually happening, we need to slow down and look at how these trade relationships were structured, and why so many African governments kept choosing China even after the warnings. The most common accusation is that China trapped African countries in debt. On the surface, this sounds convincing. China financed roads, railways, ports, and power plants. Loans were involved. Some countries struggled to repay them. But here's the part that rarely gets discussed. Most African debt is still owed to Western institutions, not China. The IMF, World Bank, and private Western lenders hold a larger share of Africa's total debt than Beijing does. So why does China get all the attention? Because Chinese loans are different. Western loans usually come with political and economic conditions. Cut spending, remove subsidies, restructure governments, open markets quickly. Chinese loans are usually tied to projects. Build this port, construct this railway, expand this power grid. The repayment is often linked to future trade revenue, not immediate austerity. This doesn't make Chinese lending good or bad by default. It makes it strategic. China's goal was never to own African countries. It was to lock itself into Africa's trade system so deeply that removing China would become impossible without causing economic damage. That's how modern power works. Take ports as an example. Ports are not just places where ships dock. They are control points of trade. If you finance, build, and manage ports, you influence what flows in and out. Chinese companies now operate or have stakes in dozens of African ports, not because China wants flags flying over them, but because ports shape trade patterns for decades. Railways work the same way. When China helps build a railway connecting a mine to a port, it's not just helping exports. It's deciding where goods go, how fast they move, and how competitive they are on global markets. Once those tracks are laid, trade follows them. Over time, African trade didn't just grow, it aligned. African exports increasingly moved toward China. African imports increasingly came from China. Supply chains adjusted. Local businesses adapted. Governments planned budgets around this trade. And this is where the power shift becomes real. When COVID hit and global supply chains collapsed, China recovered faster than most Western economies. African countries that depended on Chinese trade felt that difference immediately. Goods kept flowing. Projects resumed faster. That reinforced trust. Meanwhile, Western engagement with Africa remained inconsistent. Attention shifted from crisis to crisis. Promises were made, then delayed. Africa noticed. This is not about Africa being naive. It's about Africa being practical. Most African leaders understand the risks of overdependence, but they also understand the cost of neglect. And for decades, Africa felt ignored. China filled that gap, but filling a gap creates influence. China now has leverage, not because it demands it openly, but because it sits at the center of African trade networks. When prices change, China feels it first. When supply disruptions happen, China is already at the table. When infrastructure decisions are made, Chinese firms are often involved. This is how power shifts without anyone firing a shot. And the most important consequence is this. Africa is no longer economically tied primarily to the West. The old colonial trade routes are fading. A new system is forming, one that connects Africa more tightly to Asia than to Europe or America. That has global implications. If Africa's future growth is anchored to Chinese demand, Chinese standards, and Chinese supply chains, then global economic influence tilts east, not suddenly, gradually, quietly. And this is why the story you're watching on Finance Historian Time matters far beyond Africa. Because the same trade-first strategy China used in Africa is now being applied elsewhere, in Latin America, in the Middle East, in parts of Europe. Africa was not the end goal. It was the proof of concept. We'll look at what Africa actually gains and loses from this shift, whether this new trade system creates real development or new dependency, and why the biggest risk may not be China at all. But what happens if the rest of the world keeps looking away? At this point, a natural question comes up. If China's trade presence in Africa is so large, is Africa actually benefiting from it, or is it simply trading one form of dependence for another? The honest answer is uncomfortable, because it's both. On one hand, Chinese trade and investment have delivered things Africa needed for decades. Infrastructure is real, roads exist, ports function, power plants generate electricity. For many African countries, trade volumes grew faster in the last 20 years than in the previous 50 combined. That growth created jobs, increased government revenue, and connected African economies to global markets in ways that were impossible before. For example, countries like Ethiopia used Chinese-built industrial parks to begin exporting manufactured goods instead of only raw materials. Kenya's upgraded port and railway system reduced transport costs dramatically. Nigeria expanded its trade capacity through port modernization. These are not imaginary benefits. They are measurable. But there is another side. Trade dominance always creates imbalance. African exports to China are still heavily concentrated in raw materials: oil, minerals, metals. Meanwhile, Africa imports mostly finished goods from China. That keeps African countries at the lower end of the value chain. They sell cheap, buy expensive. This pattern is not new. It's the same structure Africa had with Europe during colonial times. The difference now is the partner. Chinese companies are also highly competitive. They bring cheap labor, large-scale and government-backed financing. Local African businesses often struggle to compete. In some countries, markets became flooded with Chinese imports, making it harder for domestic manufacturing to survive. So Africa faces a trade-off. Accept rapid infrastructure and trade growth now, or slow development while trying to protect local industry. Most governments chose growth. Another concern is political influence. While China does not openly interfere in domestic politics, trade dependency limits options. When China becomes your largest buyer, investor, and builder, decisions that affect Chinese interests become sensitive. Governments know this, even if it's never said publicly. Still, many African leaders argue they finally have bargaining power. For decades, Africa had few choices. Europe and the United States dominated trade, finance, and diplomacy. Now Africa can play partners against each other. When Western institutions tighten conditions, African governments can turn to China. When Chinese terms become uncomfortable, they can negotiate with others. This multipolar dynamic is new, and it matters. But here's where the story gets even bigger. Africa is not just a market. It is the youngest continent on Earth. By 2050, 1 out of every 4 people in the world will be African. That means labor, consumption, and future growth. Whoever dominates Africa's trade today shapes global markets tomorrow. China understands this very well. That's why China is no longer focused only on extracting resources. It is investing in logistics, digital infrastructure, telecom networks, and manufacturing capacity. It wants Africa inside its economic ecosystem, not just as a supplier. This is also why Western powers are suddenly rediscovering Africa. New investment programs are announced. Summits are held. Promises are made again. But Africa has seen this before. Words are easy. Ports are hard. So the real question becomes this. Can Africa use China's trade power to build real independence, or will it repeat history under a different flag? The answer depends on choices African governments make right now. Choices about education, about industrial policy, about diversification. Trade can be a ladder or a trap. History shows it can be both. And here's the twist most people don't expect. The biggest risk in this entire story may not be China exploiting Africa. It may be Africa becoming too important to ignore. Because as Africa's trade power grows, it becomes a battleground of influence. Not with soldiers, but with contracts, currencies, and supply chains. And when great powers compete economically, smaller regions often feel the pressure first. Once Africa's trade began tilting toward China, the consequences didn't stop at the continent's borders. They rippled outward, straight into the heart of the global economic system. Because when trade routes shift, currencies, alliances, and power structures shift with them. And this is where the United States and Europe enter the story in a much more uncomfortable way. For decades, Western influence over Africa was not just political, it was financial. Trade was conducted largely in dollars and euros. Loans came from Western institutions. Payment systems ran through Western banks. This gave the West enormous leverage, not just over Africa, but over global trade itself. China's rise in Africa quietly weakened that system. As trade with China expanded, more transactions began bypassing Western intermediaries. Some deals were settled directly in yuan, others used currency swaps. New financial arrangements reduced reliance on the dollar over time. Not dramatically, not suddenly, but consistently. This matters because global power today is not just about who has the biggest army. It's about who controls trade flows, payment systems, and financial trust. The dollar's dominance has always depended on one thing above all else, being unavoidable in global trade. Africa, becoming economically integrated with China, introduces alternatives. The United States understands this. That's why Africa is no longer being ignored. New initiatives appear. Investment plans are announced. Leaders speak about partnership again. But the problem is timing. Much of this attention comes after the infrastructure is already built and the trade routes already established. Europe faces a similar dilemma. African raw materials once flowed primarily to European industries. Now many of those flows go east. That affects supply chains, prices, and industrial competitiveness back home. At the same time, China's presence in Africa gives it something even more valuable than resources. It gives China influence in international institutions. African countries represent one of the largest voting blocs in the United Nations and other global forums. Trade relationships don't dictate votes automatically, but they shape alignment over time. This is how economic power becomes diplomatic power. But here's the part that rarely gets discussed openly. China is also taking risks. Africa is not easy. Political instability, currency volatility, and debt stress create uncertainty. Some Chinese projects have failed. Some loans have been restructured. Some investments didn't deliver expected returns. This is not a one-sided win. China is betting that long-term influence is worth short-term losses. And that bet depends on Africa's growth continuing. If African economies grow, trade expands, and stability improves, China's position strengthens. If growth stalls, debt pressures rise, or political backlash builds, China's influence could face serious resistance. This is why the future of Africa's trade is not predetermined. Africa is not a passive piece on a chessboard. African governments, businesses, and populations are increasingly aware of their leverage. They know the world needs Africa's resources, labor, and markets. They also know they have more partners to choose from than ever before. That creates an opportunity rarely seen in history. For the first time in centuries, Africa has the chance to shape trade relationships instead of simply inheriting them. But doing that requires strategy, unity, and long-term thinking, the same qualities China used to build its position. And this is where the story comes full circle. China didn't quietly take over Africa's trade because Africa was weak. It happened because the world underestimated how power works in the modern age. Power today is built with contracts, not cannons. With ports, not colonies. With patience, not pressure. By now, it should be clear that this story was never just about China, and it was never just about Africa. It's about how power actually moves in the modern world. Quietly, gradually, through systems most people don't pay attention to until it's too late. China didn't replace Europe or the United States in Africa by force. It replaced them by showing up consistently, thinking long-term, and understanding that trade is the foundation of power. Roads decide where goods flow. Ports decide who connects to the world. Payment systems decide who sets the rules. Once those systems are built, influence follows naturally. For Africa, this moment is both an opportunity and a test. Trade with China has delivered growth, infrastructure, and global relevance. But trade alone does not guarantee independence. History is full of regions that grew rich but stayed dependent because they never moved up the value chain. The real question Africa faces now is not whether China is good or bad. The real question is whether Africa can use this trade power to build its own industries, its own technology, and its own financial strength. If it can, this period will be remembered as the moment Africa finally rewrote its role in the global economy. If it can't, history may repeat itself under a different partner. For the rest of the world, the lesson is even more uncomfortable. Global power no longer shifts through wars alone. It shifts through supply chains, infrastructure, and patience. While headlines focus on conflict and politics, the real game is often being played quietly in contracts, ports, and trade agreements. The United States and Europe are not losing influence because China is aggressive. They are losing influence where they stopped paying attention. Africa didn't disappear. It was simply ignored for too long. And this is why this story matters to you. Because the same forces shaping Africa today are shaping the future everywhere. In Asia, in Latin America, in the Middle East. The world is moving toward a system where power belongs to those who build, trade, and wait. At Finance Historian Time, we don't just follow headlines, we follow the systems underneath them. And if this story surprised you, imagine how many others are unfolding right now, quietly, while the world is distracted. Before you go, I want to hear your thoughts. Do you think Africa can turn this trade shift into real independence? Or is the world simply watching history repeat itself with new players? Let me know in the comments. I read them all, and your perspective adds real value to this conversation. And if you found this story insightful, share it with someone who still believes global power only changes through wars and elections. This is how it really changes. Thank you for watching Finance Historian Time. If you want more deep, real stories about money, power, and history, make sure you're subscribed. I'll see you in the next one.